Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. March 11th, special video. A lot of volatility in the equity markets, quite a bit of volatility in the fixed income markets. So John and I thought we would take a few minutes just to take a peek at the markets, take a look at what we're doing, what are we thinking, what moves have we made, what moves may still need to be made. Why don't we start off with bonds, which although equities get a lot of the day-to-day attention in these sharp moves, have had quite a bit of volatility themselves, John.
Yes, thanks, Matt. We've seen volatility that we've never seen before in bonds. And just to give you an example of this, let's use the 2% Treasury bond due in 2050. It was issued on Valentine's Day at slightly below par. It climbed to about 117 cents on the dollar as you went into last Friday. By Monday morning, it was 135 cents on the dollar. Why? Because we saw Saudis selling oil and buying treasuries. And right now, it is back down to about 115. That is a wild, long trip in a bond. I think the important thing to realize is that where we've had volatility in other fixed income markets, the yields never got as low as they did in treasuries. So that 30-year treasury bond, which touched a low of 0.86, is now at 136, 50 basis points higher. Other instruments, munis, corporates, high yield, all are actually backing off somewhat. And why? Part of it is the equity markets and the shock and awe that has gone on with the decline in equities. But if you look at something like tax-free bonds, where 30-year bonds are yielding you 2.5%, that is actually higher than it was a couple weeks ago. We expect it may go higher. Bonds have to clear the market. The dealer community is nervous out there because they cannot hedge their positions because of what goes on in treasuries. They don't make much money on carrying bonds. And of course, you add in the personnel effects of coronavirus and a lot of people having to work remotely, it really tends to hurt the liquidity. High yield markets have gotten hurt because they're basically looked at as equity substitutes. They have gotten hurt very badly. We expect all of this to create some opportunities in the bond market. Here at Cumberland, we manage the portfolios very high grade, both taxable and tax-free. Barbell approach, short term and longer term to carry the yield, short term to provide the ammunition to go out and buy some bargains. The bargains aren't there yet, but they're coming because you're in this world where you not only had people wanting to own treasuries and not own anything else. A day like today, they didn't want to own treasuries either. So we're looking for some opportunities in the bond market. They may come sooner than we thought because of all the carnage.
Thanks, John. Equity market, we've been through this before. S&P, I guess it brushed up against that down 20 mark from its high, which John mentioned Valentine's Day. It was just back then we were flirting with highs. We've had the fastest 15 to 20% sell-off from all-time highs ever by a large margin as well. The second fastest was just back in December of 18. So trading in these markets has been highly volatile, and positioning is important. I wanted to mention a couple of things you may be seeing in your accounts. In terms of our U.S. strategies, we haven't done anything the last few days. We had raised some cash. We're, call it 20% cash in our U.S. strategies. So for the time being, we're laying low. We're still there. There's a couple of reasons which I'll get into. Tactical strategy. We're about 22% cash. Part of that was hitting a stop today in small cap. That had been a weak relative strength area, severely, well underweight in the portfolio. Did hit a stop. One thing you always do in volatile markets is respect your stops. Mistakes are always made, be it 2008, 2001, 2002, 98, having traded through those. The biggest mistakes you can make are not respecting your stops and thinking that you know valuations better than the market. So how do we attack this? We have cash. We're looking at different levels. I've mentioned to clients, I mentioned on a video before recently, we like to bid under the market. Try to let that market come to us. We did it recently in a couple of buys. Right now they're treading water, holding their own down a bit from where we bought them. But very, very dangerous to chase up days. As you know, in terms of clients, as you know, we haven't done much buying the last 3 months. As a matter of fact, newer clients from Thanksgiving on, their equity accounts are, probably 50–60% invested, which leaves a good slug of cash. Long-term clients who know how we trade, many of you have traded with me for 20, 25 years, you know that these dislocations are where we buy quality. Look back on current statements. Look back at $9 Apple. Look back at $35 Google. Look at some of these names. These names are bought in dislocations. We may not be at the end today, but one indicator I like to look at on the CBOE is, as you know, I've mentioned this on videos often, the equity-only put-call ratio did hit 112 on Monday. Now we got the immediate move on Tuesday and gave that all back today. Be interested to see when the CBOE puts out their numbers in an hour or so, if we cracked 1 again. Remember, what does that tell us? It means more puts are being bought than calls. Very unusual in the market. Calls are used for many things in a portfolio. Hedging, directional bets. Normally they'll carry, you're at a 60, 70, 80% put-call ratio. In other words, only 60, 70% puts being bought versus calls. When we crack 1, it's time to start just paying attention on a buy list what you may be interested in. Don't be overly aggressive. We're going to be patient. We're going to nibble. We have names and values we're interested in. But we thought this was an opportune time to have a chat. Clients, make sure you're calling us. Make sure you're emailing us.
Please do.
We're, as you can imagine, markets have us dancing around a little bit. We certainly want to speak to you. So make sure to reach out. Happy to have a chat. Happy to review accounts. Happy to review plans for the next 30, 60, 90 days. We'll see you back Friday. That's only in 2 days. Remember, this was a special Wednesday edition of the trading video.